It is December 12, 2025. If you thought the rate cut was the big news, you missed the most important news from the release. Hidden in operational data released by the New York Fed is the smoking gun we've been warning you about on this channel for the last 3 months. The Federal Reserve just announced they are officially entering the market to buy 40 billion of Treasury bills over the next 30 days. We told you the pumping was clogging, we told you liquidity injection was inevitable, and now it is here in black and white. Let's look at the document. The FOMC has directed the New York Fed's trading desk to conduct reserve management purchases. Starting tomorrow, they are buying $40 billion worth of short-term government debt. They are calling this maintaining ample reserves, to avoid calling it quantitative easing, but let's call a spade a spade. This is money printing to soak up government debt. Remember back in October when we showed you that chart of the reserve repo facility hitting zero? We said the Fed would have to panic buy T-bills to keep the repo market from seizing up. Well, here is the validation. They aren't just letting bonds roll off anymore, they're actively expanding the balance sheet again to the tune of 40 billion a month. Why specifically T-bills? Because the US Treasury has been fooling the market with short-term paper to fund the deficit. The market is choking on it. By stepping in to buy these T-bills, the Fed is essentially monetizing the deficit at the short end of the curve. They are taking the supply off the market to force short-term rates down and ensure the government can keep paying its bills without spiking the repo rate. And it gets better, they aren't just buying 40 billion, they're also taking every dollar from the maturing mortgage bonds and dumping that into T-bills. It is a total rotation into funding the US government's daily cash needs. What does this mean for your portfolio? Liquidity is back. When the Fed buys 40 billion of assets, that is 40 billion of fresh cash entering the financial system. Historically, this not QE has been rocket fuel for risk assets. We saw this in 2019 during the repo crisis, and we are seeing it again now. The Fed has officially blinked. They're prioritizing market function over fighting inflation. The great pivot we predicted in the channel is confirmed. $40 billion in 30 days is just the start. If you want to stay ahead of the next liquidity injection, make sure you're subscribed. We read the fine print so you don't have to. See you in the next one.